So here's the story that I want to talk to you about today. Let me start by just introducing you very quickly to what microfinance is all about. I suppose you do know it because I have two colleagues at least with whom I have co-authored papers at LSE. One is Tim Besley and the other one is Matthias Gatak. So what is microfinance? Microfinance is a set of financial innovations that are designed for the poor. The most well-known is microcredit, but there is microinsurance, there is green microfinance for the environment, there is micro savings, and so on. And the interesting story that I'm going to share with you today is our sheer excitement about why microfinance contributes to economic development. So first, as you know, many of those people that we sort of study in economic development live in agriculture, and their income is volatile. So for consumption smoothing is a very good idea, and this is what microfinance is doing these days. In the advent of the Great Recession now that we're living, this is what micro-entrepreneurs are doing. They're basically contracting loans for consumption. We'll see that later on. But most importantly, the idea started because microfinance can actually serve to startups, serve to finance startups, because we believe that the people are talented and they decide to their projects, even though they don't have collateral, should be financed. So let me give you some publicity. I am about to produce the third edition of my book with Jonathan Modak. It's been translated into several languages. And what I will focus on, assuming that you do not know much about microfinance, is actually chapter 4 in my book. So you probably know the story. The story dates back to the 1970s. It started with Yunus, the Nobel Peace Prize in 2006, who actually had this idea of people or taking advantage of what we call social collateral, that is putting people into groups of 5, and they would be jointly responsible for the loan. So when I visited Bangladesh back then, in the 1980s, people would actually meet in groups of 8. So there would be 8 groups of 5 each. So he's an economist, and we started thinking about the rationale for this. So starting with Stiglitz, then Varian, then Besley, then myself, we actually. So how can we be sure that they will repay? The technique that I am going to talk to you about, you probably are already familiar with it, is group lending. And let me open a parenthesis here. Nowadays, you probably have experienced yourself at the LSE. We as instructors are very much in favor of creating groups, not associatively or non-associatively. In other words, groups that are heterogeneous or not, second years with third years, or of different backgrounds. Some from England, or other from the East, or the other ones from Europe, right? And the idea is very much coming from potential entrepreneurs that will hire you at some point and will want to know whether you know how to work in a group. So I know there are free riding problems and so on and so forth, because I've been studying group lending for a long time now. So this group lending idea that emerged in the 1970s in the Grameen Bank is not new. There are some predecessors. One of them has been largely studied by Tim Besley, which is called Rotating Savings and Credit Associations. it has various names in different parts of the world. They are called Kai in somewhere in Korea, in South Korea. They are called Pollas in Chile, and Tandas in Mexico, and so on. But the idea is that people get together into groups, and they actually bring, say, $100 per month, each of them, and someone randomly gets the pot, and that person that gets the pot becomes a debtor, and the other ones are the creditors. So he has to reimburse these $100 by, turning up in several occasions until the last person gets the pot. So it's a way of saving and a way of getting hold of, in case of a group of 10 people, you get hold of $1,000 immediately, right? So if you are number one in the queue, of course. And of course, in the 19th century, you have credit cooperatives that were emerging first in Germany and France, and they work more or less on the basis of people having a common bond. So if you belong to the LSE and you are third-year graduates, well, there's a lot of pressure for you to actually repay your debt, and you would not want to leave or darken or tarnish your reputation by not doing so. So in group lending microfinance, the institution requests that all the potential borrowers get together and they individually contract a loan, say $100 per person, but they are jointly responsible for the loan. In other words, if one member, assuming we are 5 members, one member defaults, the other 4 have to repay the share of the defaulting ones. How exactly they sort of split the losses, that's a question that we do not know. But in general, people respond very well, and they have the adequate incentives to sort of screen, monitor, and enforce repayments, what we call incur and agency costs. What does that mean? What this means is that, in general, a bank will ask for your credit history, and that's screening who you are, and will monitor from time to time what are you doing with the money, if you are investing the money, and if you don't repay, they will hire a lawyer, and the lawyer will go after you, right? So these activities, which are called agency costs, right, are actually activities that are delegated to the borrowers themselves. Why? Because they, by jointly getting together, or by the institution asking them to get together, what they do is that they very cleverly choose who the partners are. It's pretty much when they ask you, okay, you are going to do a joint research paper, well, you know who to peer with, right? Because you know each other for about 2 years now. Well, it's pretty much the same thing at the screening stage. But then there is a monitoring stage. So suppose that we are, the 5 people, and we live close to one another. One of us does, raises chickens, and I will make sure that the person is waking up in the morning and, feeding the chickens. And the last, which I have worked extensively on and done a lot of papers, is enforcement. In enforcement is that, well, the person might have a positive return realization and can actually repay his debt, yet he might decide against repaying his debt and take the money and run, right? So how can we prevent that? Well, in these close-knit societies, if someone does that, the entire group and the entire community knows about it, and this person is somewhat penalized. Say, it incurs in exclusion costs from the social events organized by the community. The trade credit, for example, lend me some money to buy a piece of bread and I will pay tomorrow, or lend me some money or you give me a bowl of rice and I will repay. That doesn't exist, right? So this delegation of agency costs is efficient in that it is not the bank that has to incur the costs, it is the borrowers themselves that are doing it. So I have explained why they live close to one another, and because most people actually save in agency costs, or most banks save in agency costs, and these banks are assumed to actually break even, or are NGOs, or are competitive. What will happen is that the interest rates that the microfinance institutions charge are lower than those that a money lender will charge. Not lower than the ones that the commercial banks will charge. And we'll come back to that question but lower than what the money lender will charge. So they fluctuate somewhere between 30% and 90%. Probably they have gone up recently for the reasons that I will explain. So what has happened over the past 40 years? A vast majority of microfinance institutions report repayment rates exceeding 98%. Any commercial bank would want these repayment rates. And there are millions of microfinance institutions in the developing world. We will see what they look like in a minute. So they are currently serving over 2 million households, but those are statistics for last year. We will see that this figure is at least now 3 million households, and we will come back to that in a minute. So what are the advantages of actually including the poor into the financial system one way or another? Well, offering loans at affordable rates, what it does is it relaxes credit constraints, so the poor are not credit constrained, and if these loans are invested, then actually that increases investment and increases growth in an efficient way. What do we mean by efficiency? Well, it is good for making the pie bigger, right? Any investment with positive returns makes the pie bigger, and is equitable because the vast majority, 8 out of 10 microfinance entrepreneurs are women. So on gender equity grounds, this also makes sense. So on the basis of this, there were a large number of financial aid institutions that were delivering loans to the poor via the group lending methodology. So here are some pictures of myself here in Bangladesh, and my own replication. I got seed capital from they call it seed capital from a German institution, and I created my own. I studied it, and I have photographs of some of the borrowers in southern Mexico here. I studied this so I did empirical studies, and I will talk about it if we have time about my empirical studies, although they are not, guiding policy for replications of randomized control trials are, difficult to do because they are context specific. So external validity of those randomized control trials is a problem. But let us just formally assume that we're going to be talking about ex ante moral hazard. What does that mean, ex ante moral hazard? Suppose that I borrow money, but I might be lazy or I might not be lazy, right? If I put effort, the probability of success in terms of repayment rates is higher. So if an investment requires, say, 1, can be $1 or $1 million or 1 million taka, right? A borrower that puts effort and invests one, right? It will get, say, Y, which is higher than 1 with probability 1. And if a borrower does not put any effort, so the borrower is a lazy guy, right? It invests one, but it only gets it invests 1, but it only gets 1 with probability P, that is P less than 1. It obtains 0 with complementary probability 1 minus P. So let us, how do we actually define this? How do we solve this idea? Well, our objective is that the financial institution has the incentives to actually lend. So what is the payoff that the financial institution will get if the borrower in question puts effort? We're talking about an individual borrower here. So, well, it gets Y if it puts effort, and the borrower actually is adopted an R, which is a repayment rate, what it has to repay, say the one if the interest rate is 1% is say 1.1 minus the cost of monitoring that for the time being is not high, or it might be 0 because we are not assuming that this borrower is contracting the loan with somewhere else. Now, if it puts no effort, then the probability will be P. It will get Y minus what it has to repay, R, assuming enforcement problems don't exist. So what is the repayment rate that the bank can charge? The repayment rate that the banks can charge, the maximum repayment rate, is Y minus C over 1 minus P. Assuming C equal to 0, then you will see that what we have to compare, or the important comparison, is when we really talk about two borrowers. When we talk about two borrowers, then the income that the two borrowers will get is no longer Y. It will be 2 times Y minus 2 times R, that is 2 times 100 or 1.1, what they had to repay, minus twice the effort C. In this case, yes, effort must be positive for this whole thing to actually work out. And what happens when there is no effort exerted from the borrowers? Then the repayment that the bank gets is P squared, right? 2Y minus 2R, no effort. Simplify matters. And what is it that we find? What we find is that on the individual borrowing, what we have is C, Y minus C over 1 minus P squared, which is greater than on their individual borrower under no peer monitoring. So when there is monitoring, you have the repayment rate is higher. So this way of getting around the problem is by backward induction. First, you decide whether it is profitable for the bank it's profitable for the borrower to repay, and then you define from there what the repayment rate is. And all I'm saying here is that the repayment rate is higher, and that repayment rate is a repayment rate which is not too high, so that borrowers are not defaulting. Now, what happens in an exposed moral hazard program? Well, as you know, exposed moral hazard means that if I have a return realization which is positive, I will take the money and run. How do I actually deter that individual from doing so? So we have 2 scenarios here. One is a scenario when there is no strategic default, because strategically I'm taking the money and I don't want to repay. And the other one is the strategic default scenario, in which case, what is it that the borrower gets? The borrower gets Y minus Q, which is the probability of getting caught, times R plus D. And D is the social sanctions, the social sanctions that I talked to you about, being excluded from religious events or whatever. So what we have here is a very revealing equation that tells us that the repayment rate must be equal to Q over 1 minus Q times D, right? If D, which are the social sanctions, are 0, then the repayment rate is 0 and the bank will not lend, right? So, and similarly, if Q, which is the probability of being monitored, is 0. So, as you can see, this is a very, very sketchy way of getting around the problem. There are all sorts of models that will tell you the reasons why this type of institutions will actually be able to lend and get a return of, repayment rates that are 98% at interest rates which are as high as 30 or 40%. Now, let me wrap up. Group lending with joint responsibility circumvents adverse selection, moral hazard, ex post and ex ante. We saw two models here, and enforcement. So delegation of agency costs does involve efficiency because, as we saw, the pie gets bigger, and because on gender equity grounds, more women come into the bank and are included into the financial system one way or another. It is a very widespread methodology. For 30 years, we couldn't get out of it. There are different versions, but in Grameen is the 5 group, but in Latin America it's called village banking, and it's 30 groups, and they take advantage of economies of scale. So it's potentially more efficient. There is a debate on that. So it seems to work well in very densely populated areas. Now, what happened with COVID? Well, clearly, this idea of group, as we can see, disappears because the borrowers do not have any technology to actually get together like this, and they can hardly manage, this kind of transfers via mobile banking to repay. So the big problem that we have as people that have our hearts close to the borrowers or the poor is that the microfinance loans are not being used for investment, but for consumption. So this is not new. This precedes COVID. And in the writings of Banerjee, that won the Nobel Prize with Esther Duflo 3 years ago, wrote an article called The Miracle of Microfinance in 2015. And in a randomized control trial, they found that the vast majority of the loans by a microfinance institution were either consumed and not necessarily consumed in nutritious food, but some flavory food that contains a lot of sugary and fatty stuff that we want to avoid, and also that when the loan was contracted for investment, it was for expanding existing business, not for startups. So we were a bit disappointed with those findings, but again, those findings are for India and for an ex-place in India. The organization is called Spandana. So there are many organizations there. The problem is that, when you move away from group lending, you need some kind of collateral. If there is a group that comes and co-signs the loan, you can lend, you can borrow individually in group lending, because you have an entire group that is backing you up, and the group really might be former borrowers. They are endorsing your loan in a way. It's like a letter of reference, but for people. But when you move to individual borrowing, generally during COVID, this doesn't happen, or this didn't happen. Loans were extended, and they were extended at the very high interest rates because the probability of repaying was very low. Even if the borrowers wanted to repay with money from their families or from their relatives, they were unable to, right? The other thing that happened, it accentuated a trend on the maturity of the loan. The loans were no longer extended on a 1 year or 2 years basis, but they were shorter term loans. There were all sorts of loans that disappeared, such as housing loans, because they were repayable in a longer period of time, and at an individual basis. So similarly with insurance, loans for insurance, leasing, savings, etc., well, were all scratched. So we ended up in a scenario where microfinance institutions were tightening the credit constraints that the borrowers face, and the savings constraints, that these could not go to the bank and put their money in there, which is a way of making their savings safe, because they live in areas where violence is widespread and they can be their little savings can be stolen. So what do we have as of today? So if you Google microfinance, you will end up with several players which are not necessarily the most charitable or players that are charging 30 or 40% interest rates. Most of them are really, they look very much like banks. You can be one borrower if you want, or you are in China, right? By clicking in this link. So these are, I listed the 5 most important one. One is 51 Give. The other one is ABN loans in Nigeria. The other one is Abdudabya in India. And the other one is Access Holding in Europe. So Eastern Europeans rely a lot on this microfinance enterprise, which is like a bank. And in the United States, Action East serves a population mostly migrants and impoverished people. What are the projections? Well, the projections is that if you see what is happening with the microfinance sector, what happens is that the vast majority of them in 2020, right, they were not really banks, but in 2030, it is projected that they will be all regulated banks like Barclays, Lloyds, or HSBC, right? And they will be called microfinance institutions, and they will become non-banking financial institutions, which are very similar to banks. But most importantly, you have microfinance institutions like Compartamos or any of the ones that I mentioned for India or Nigeria, right? And very, very few others. Others meaning non-governmental organizations. That is, NGOs are not important players now and are projected to be playing zero role in the future, if only because there is no money coming from donors as it used to be the case. So what is the main existential problem that we as microfinanciers in the theoretical we as microfinanciers in the theoretical or in the classroom have, right? If banks are actually playing a role there, is because the amounts that they are lending are large. So what is the difference between being a borrower in a microfinance organization such as, Give, and being a borrower in Barclays? Well, from my standpoint, none. But the loan amount that you request is large, and you have to have collateral, some form of collateral. More interestingly, a large number of people, including us, do not have, financial or are computer or literate, especially for seminars when it comes to delivering a seminar, right? Via Zoom, but no, I'm just kidding. Just online transactions are difficult for an illiterate person, and that therefore they are not really targeting the poorest of the poor. And the big problem that we have discussed extensively also before COVID with my co-author Ariane Safars from Belgium, something which is called mission drift. What does that mean? That when the banks will want to actually meet that self-sustainability goal, they also are at odds with their mission via extending larger loans. And larger loans are equivalent to targeting borrowers that are less poor than the borrowers that we originally show you. So you can see this paper by myself and Safars in this link here. I know you are all tired, and that I am more than happy to take questions on. If you want, I can actually put my things on.
Cool. Thank you so much for that presentation, Professor. I think it was really insightful. If anyone has any questions, I think now is probably the best time to ask. But yeah, it's pretty much just an open discussion. Does anyone want to go first, ask the initial question? Yeah, of course. Go ahead.
Sure. I was curious in the discussion about COVID-19 and the impacts on microfinance. You mentioned kind of the changes to the structure with the lack of ability for groups to meet. But I was curious if there's been any analysis on defaults increasing, because I would assume that would be a byproduct of COVID as well.
Can you hear me?
Yeah.
Yes.
Okay. Indeed, defaults increased on the group lending methodologies, and it was not a product of the design of the loan, which was a group loan with a joint responsibility, but a design of the recession that the borrowers experienced. In other words, they were, barely able to put food on the table. So they were not borrowing from relatives to repay their loans or anything. So yes, we would have expected a return to the normal, right, after COVID, because borrowers can now meet. But there is a great deal of debt overhang there. These borrowers no longer want to approach the institution because they owe them money. So no one is, forgiving those debts yet. The sector is somewhat struggling, and some microfinance institutions are closing their doors. They are completely bankrupt. So if I am a borrower in a microfinance institution and I belong to a group and the entire group just doesn't turn up, then you don't have any more clients. You just close your doors and you start serving or you start serving a population of new borrowers that are making money via selling, I don't know, individually face coverings or whatever in the best scenario. So yes, there was a chain of bankruptcies on the group lending, and that explains some kind of debt overhang that weighs heavily on the microfinance organizations. And even if they were able to meet, the borrowers can, barely meet or put food on the table. So they are not there to repay, unfortunately.
Thank you.
Anyone else have anything they want to ask or learn a bit more? Go ahead.
So why do NGOs not have housing in the last few years? What's the reason behind the financing?
So there are very well established NGOs. They have managed to educate the borrowers prior to COVID on how to make online payments, for example, with their mobile devices. And those borrowers would actually value being clients of very well-established institutions such as BRAC and Grameen, which are non-governmental organizations, or Banco Compartamos or other village banks that are not really commercial, so to speak. They valued it very much, and wherever they had, they restructured their debts. So yes, these financial institutions have survived. It's not that they have disappeared, but the competition has decreased. So BRAC no longer has 100 competitors. It is now probably one competitor, which is Grameen, as far as I know. And it's involved in a lot of other activities. For example, probably you have heard about Bcash. That belongs to BRAC. So that is what has happened. Not every non-governmental organization disappeared. Many did.
Thank you.
You're welcome.
I noticed that Raghav had a question. You raised your hand. Do you want to ask that?
Yeah, hi, sorry. Can you hear me?
Yes.
Yeah. So I was very interested in, you mentioned, I think quite briefly, but it seemed really interesting, this point about microfinance, not as a tool just to alleviate poverty, but also for gender equality and trying to use that. I was kind of curious what form that took. Is it, for example, lending mainly to women in some aspects, or is it like kind of a change within the lending? I think the group lending itself, you lend to perhaps a wider variety of people. I'm very interested in how microfinance can be used as a tool for gender equality, and I'm curious about your thoughts on that.
Thank you. This is a very interesting question. Thank you for asking it. Let me explain you. On the demand side of the spectrum, if you ask men to get together into a group, you will find that there is a less degree in close-knit societies, village economies, a less degree of solidarity. You will find very few men that will want to actually get together to contract a loan. Number two, we know that poverty is more widespread across a population of women, if only because they are engaged in maternal activities and they cannot really be, in some instances, go out to the market in Islamic societies and sell, right? So women are staying at home, more or less, and they do little business such as being a hairdresser or knitting or engaging themselves in some kind of activity, chickens or whatever inside the house. So and they are talking to one another a lot. They are very solidar to one another. Interestingly, when I ran an experiment in southern Mexico and I wanted to introduce men into women-only groups, the take-up rate was something like 7%. And I was very surprised because what I wanted was to introduce husbands, and that's the name of the paper, inviting husbands. And they just didn't want. Some of those women are so disempowered within the household that they hide their finances or they hide their money that they have accumulated for repaying their debts from their own husbands. So that is on the side of the demand. A woman demand to be in a group of women. The other, and men are reluctant to join a group. Now, on the side of the supply, if you speak to the microfinance institutions or the managers of microfinance institutions, they will tell you, if you give me the choice between lending to a man or lending to a woman, I prefer to lend to a woman. They are more easily, I can't trace them. It's not that they are, going to migrate to the United States. I can intimidate them a lot easier. They are more fragile in terms of suffering from social ostracism or social religious events. So this is one of the reasons, one of the many reasons. In some instances, we tell them how to defend themselves from male borrowers and their own husbands. So it's a combination. I do not believe that it was intended for women in the first place, but it attracted a large number of women for demand and supply considerations and via trial and error. You see, so yes, there might be some individual borrowers, but that are male, but they might not, or the vast majority of them are not in groups.
Great, thanks. Really interesting.
Welcome.
Lots more to look at, I guess.
Yeah, of course. Go for it.
Yes. In recent years, there's been kind of an increase in criticism towards microfinance, and in particular that maybe it doesn't actually help people move out of poverty. And I'm curious just to hear your thoughts on that, or how you would respond to the critiques.
Well, as you know, poverty is multidimensional. At first, we thought that giving money and relaxing the credit constraints of women, who are the main, the backbone of health and education, we would actually contribute to meeting a higher development goal that involves these three aspects of at least these three phases of poverty. One, more literacy. Second, better health. And third, more income. If we actually lend to women. So this relates to my earlier comment on women. But we know that poverty is much more than that. Poverty does occur in countries that are war torn, and it is very difficult to actually take that variable out of the equation. There is a lot of fractionalization and a lot of violence that takes place, and there are other fundamental causes of poverty. For example, geography. In in the advent of an aggregate shock, such as a typhoon or wherever, you lose the entire crop, and you cannot even lend to your wife or to your sibling the money for repaying if she is not, experiencing financial difficulty. It's the entire household that is suffering. So, we saw that it was not possible to sustain, especially in developing countries. Not surprisingly, in China, that is industrializing very rapidly and is growing, and even in Bangladesh, the microfinance institutions are growing, and I strongly believe that there is not a person that would tell you this is not alleviating or at least contributing to poverty alleviation. I strongly believe it is, but it depends on how you measure poverty. So if you just ask how much did you earn yesterday or last year as opposed to how much you earn today, you will find that yes, it has increased the income, but how that is spent, is the business blossoming or growing, you will see that is not. And partly it's also the fact that not many people now live on loans from microfinance organizations. A lot of people have greater access to family loans, for example, at 0 interest rates. So, in a growing economy, yes, I believe that it is contributing. I believe that no one will tell you that it is not, but there is no way to prove it. If only because really poverty is multidimensional. So if you are spending in better education, more education, or more years of education of your child, that is not something that you can tangibly see, or the returns of the loans that you got for education can actually be tangibly seen in the short term.
Thank you.
Anyone have any more further questions, or shall we wrap up? Okay. Cool. Thank you so much again for speaking to us today, and sharing your wisdom on the field of financial inclusion and microfinance. I think it's been really insightful and really useful for us today. I understand that there were some technical difficulties at the very start, which did delay us a bit, but I think after the presentation started, I think it was a lot better, and we're very grateful for your presentation today.
Thank you very much for inviting me, and I am very close. I go up to the LSE in some instances, and that was my intention today, to do some exercise, and unfortunately I couldn't. But if you're writing a thesis, or don't hesitate to drop me an email and tell me, I am interested. Do you have data on this, or I would like to do research on whatever you want. I'm planning to set up a lab with an ESRC grant in 1 year approximately. So you're all invited to join. Thank you very much for inviting me again. Bye-bye.